Ever heard of Moneyball? You know that movie about the Oakland A's and how they kind of like revolutionized baseball?
Yeah, they used data and stats instead of just, going after the big name players, right?
Exactly. They focused on things like on-base percentage, stuff that other teams weren't really valuing. And guess what? It worked. They built a winning team, consistently got on base, scored runs. And that's what we're doing today with dividend investing.
So instead of just chasing after the Coca-Colas and Johnson & Johnsons of the world, the big names everyone knows,
Right. Or just buying what Warren Buffett buys.
we're going deeper, looking for those undervalued kind of hidden gems that might not be flashy but deliver consistent, steady income.
We're talking Moneyball for investors. How to build a dividend portfolio that's, well, kind of unstoppable. It's all about those consistent wins, those regular payouts. The market ultimately cares about results, not just hype.
It's true. It's about building that machine that just prints cash for you over time.
So today, we're going deep. We're giving you the playbook, the shortcut to building a dividend portfolio that just wins. No fluff, just the stuff that really matters.
Absolutely.
Okay, so let's get started. When you're scouting for those dividend all-stars, where do you even begin?
Well, first things first, you got to understand dividend yield. It's often shown as DY. Think of it as like the on-base percentage for a stock.
So like how often does it pay out? Or
It tells you how much income you get back, like relative to the price of the stock, so a higher yield. Well, it seems great, right? But
Yeah, that's where it gets tricky. Because if something seems too good to be true.
exactly. Sometimes a super high yield, like, 12% or something, could mean trouble.
Oh, really? Why is that?
It might mean the stock price is tanking, which makes the yield look bigger, but it's not actually a good thing. Or maybe the company's in trouble, like, say, a REIT that's struggling. That big payout might not last.
So those massive yields aren't always what they seem?
Nope. You want to look for healthy, well-established companies. For most blue chip and mid-cap stocks, a yield between, say, 2.5% to 6% is a solid starting point.
Okay, so dividend yield is important, but it's just the beginning. What else should we be looking at?
The payout ratio. This tells you how much of the company's profits they're actually paying out as dividends. Ideally, you want this to be under 70% for most industries.
So like they're making enough to comfortably cover those payouts without, going broke.
Yeah, that's the idea. You don't want a dividend that's like a Ponzi scheme.
Right, unsustainable. Makes sense. What's next on our checklist?
You got to look at the dividend growth rate. It's often shortened to DGR. It shows you if the company's consistently increasing their dividend over time or if it's just flatlining.
So it shows whether they're committed to giving back to shareholders and whether they're growing their earnings so they can keep those payouts coming.
Exactly. A good DGR shows you there's momentum behind those dividends. Now, one thing people often miss is the actual cash flow. Earnings can be a bit misleading sometimes.
Yeah, profits on paper don't always mean there's cash in hand, right?
Exactly. That's where free cash flow comes in. It's often called FCF for short. It's the actual cash they have left after paying for stuff like, buildings and equipment. It's a much better indicator of whether they can actually afford those dividends.
Got it. So strong free cash flow means they're not just faking it. What else should we consider?
The company's history, their track record with dividends. Have they consistently paid and increased their dividend even during, recessions, inflation, all that stuff? That shows real resilience.
Like think of them as the Mariano Rivera of your portfolio.
Right.
Right. They just deliver no matter what's going on.
Perfect analogy. You want those dependable players.
Okay, so we've got our key Moneyball stats. Dividend yield, payout ratio, dividend growth rate, free cash flow, and a solid dividend history. That's a way better way to evaluate a company than just chasing those big yields, right?
100%. Now, the next step is to build your actual portfolio, your lineup of dividend stocks.
So like building a baseball team, we want different types of players with different strengths, right?
Right. You wouldn't want a team of all sluggers who strike out all the time. You need balance. Same with your dividend portfolio. Let's start with your leadoff hitter. Think of a company like Procter & Gamble, PG.
Yeah, they make everything, right? Shampoo, detergent, diapers.
Right. Their yield might be around 2.5%. Payout ratio around 60%. 10-year dividend growth rate of maybe 5%. Solid, consistent, not flashy, but reliable.
Gets on base every time. Who's batting second?
For a contact hitter, we need a dividend aristocrat. These are companies that have increased their dividend for at least 25 years in a row. Take Johnson & Johnson, J&J.
Another household name.
Their yields may be 3.1% payout ratio in the mid-50s, and they've been increasing dividends for like over 60 years straight. That's dependability.
Wow, that's impressive. Now, any team needs a power hitter, someone who can really drive in those runs.
True. For a high-yield option, consider Altria, MO. Their yield might be around 9%, payout ratio maybe in the high 70s. Now, they're a sin stock, tobacco.
Right, so there's some risk there.
But they've been a very consistent dividend tester. You got to weigh the risks and rewards there.
Higher payout, but more to think about. What about adding some defensive plays?
For a defensive utility, consider a REIT like Realty Income, although they might have a yield around 5.4%, and they pay monthly dividends, which is nice.
Oh, I like that. Monthly income. What's their business model?
They lease out essential retail properties, so their cash flow is very steady. It's like having a player who's a great fielder and a reliable hitter. Now, we also need some growth potential.
A rising SAR.
Right, a dividend challenger. Think of a company like Texas Instruments, TXN. They might have a yield around 2.9%, but their dividend growth rate could be 15% or more.
So the payout might start lower, but it has the potential to really take off as the company grows.
Yeah.
What about some steady veterans?
For that, you want a utility stock like Duke Energy, DUK, yield around 4.2%. These companies tend to be in regulated industries, slow growth, but very stable dividends.
Solid performers, especially when things get shaky.
Exactly. Now, to diversify your portfolio, you might want some international exposure. Think of a company like Enbridge, ENB.
Where are they based?
Canada. Their yield might be around 7.5%. There's currency risk, of course, but it's a way to add some global balance.
Good point. What about some backup players, some bench depth?
A good option there is a financial stock like T. Rowe Price, TROW. They might have a yield around 4.3%, very low debt, strong brand. They can weather the storms.
Reliable, even when the market's going crazy.
Yeah.
And what about ETFs? Those seem like an easy way to diversify.
For that, you want a monthly dividend ETF. There are options like JPI or SCHD with yields ranging from, say, 6 to 9%.
So instead of picking individual stocks, you get a whole basket of dividend payers.
Yeah, built-in diversification. Less research, but still solid income.
Okay, so we've built our team, but how do we avoid those dividend traps?
Those are companies that lure you in with huge yields, but there's trouble underneath.
Yeah, it's like if it looks too good to be true.
Usually is. That high yield often means the stock price is plummeting because there are problems with the business. Always. Always do your research.
Don't be fooled by that shiny yield.
Exactly. You should also watch out for companies that are funding their dividends with tons of debt. It's unsustainable. Look at their debt-to-equity ratio and interest coverage ratio. Another thing is, does the company have a moat, a competitive advantage that makes them tough to beat?
Like they have something special that protects their business.
Right, yeah. If they don't have a moat, they're vulnerable. And finally, don't just rely on past dividend history. Look at their free cash flow, their guidance for the future. Make sure they can actually keep those payouts coming.
So it's all about digging deeper, looking beyond the surface.
Yep. Now let's talk about those key metrics, the Moneyball stats we should be using to evaluate potential investments.
Our scorecard, basically.
For dividend yield, that sweet spot is generally 2.5% to 6%. Be very careful if it's much higher than that. The payout ratio, ideally under 70% for most companies, but REITs and MLPs can be higher. Then look for a dividend growth rate of over 5% annually. You want to see at least 10 years of consistent dividend increases, positive free cash flow growth. Keep an eye on their debt-to-equity ratio. It should be below 1.5, and their interest coverage ratio above 5.
Those are a lot of numbers. It seems like a lot to keep track of.
It can be, but once you get used to it, it becomes second nature. Now, here's the thing. You can't just set your portfolio and forget about it.
It's not a one-time thing.
You have to be an active manager. Just like a baseball manager keeps tweaking their lineup, you need to keep an eye on your dividend stocks.
So, how often should we be checking in?
Quarterly, at least. Look for any dividend increase announcements, see how the companies are doing in terms of earnings, any big changes in their industries, and then once a year, consider reallocating some of your investments.
So selling some, buying others.
Yeah, you might shift your money from underperformers into companies that are growing faster. And be strategic with DIPs, those dividend reinvestment plans. You don't have to reinvest every dividend, just the ones you're really confident in. And most importantly, don't panic sell just because the market's having a bad day.
So stay calm, stay focused on the long term.
Exactly. Now we got to talk about taxes.
Ooh, everyone's favorite topic.
I know, right? But it's important. There's a difference between qualified dividends and ordinary dividends. Qualified dividends are taxed at a lower rate.
So we want those.
You got it. To qualify, you generally need to hold the stock for over 60 days in a certain time period around the ex-dividend date. Also, use tax-advantaged accounts like IRAs and 401ks whenever possible. And don't try to game the system by buying stocks right before the ex-dividend date. It doesn't really work.
Gotcha. No shortcuts there.
Nope. Now remember that the dividend yield is only part of your total return. Your total return includes both the dividends you get and any increase in the stock price. So a stock with a lower yield but strong growth potential could actually outperform a high-yield stock that's just staying flat.
So it's not just about the income, it's about the overall value growing.
That's the key. So, to wrap things up, let's bring it back to that Moneyball mindset. What does that mean for everyday investors?
How do we apply it to our own portfolios?
It's about using data, not emotions, to guide your decisions. Ignore the hype, focus on the fundamentals, and think long-term. Don't try to get rich quick. Just build that steady, reliable income stream.
Like a machine that prints money.
Exactly. And remember, the goal isn't to copy someone else's portfolio. It's about finding those undervalued opportunities that fit your goals.
So to sum up our Moneyball approach to dividend investing, it's about consistently getting on base with reliable dividend payers and using those key stats we've talked about to evaluate your investments. It's not about hitting home runs. It's about those consistent wins, those steady payouts that compound over time. Time in the market beats timing the market every time.
Couldn't have said it better myself. Consistency is key.
So as you're listening to this, think about some companies you're already familiar with. Based on what we've talked about today, those dividend metrics, their history, do any of them stand out as potential Moneyball picks? Maybe that's a good place to start your own research. Thanks for joining us for this deep dive.
It was a pleasure being here.
Until next time.
See ya.